Welcome back. Given we have a pending Federal Reserve decision and the anticipation of lower rates might be right around the corner, we thought it might be appropriate to talk about the 10-year US Treasury minus Fed funds. It's a very unusual indicator that is very effective and very useful during times of change between the relationship, the 10-year Treasury and Fed funds rate. We're going to show you exactly how this works. We're going to look back to the charts historically to see what has happened in the past, and we're going to look at what is going to happen in the near-term future, possibly. 10-year US Treasury moves with the economy. A strong economy sends yields on the Treasury bonds higher. Lower rates certainly indicate cooler economic conditions as well. Federal funds rate, interest rates, high rates are used to cool down the economy if inflation gets out of control. Lower rates are used to stimulate economic conditions. The crossovers between the 10-year US Treasury and federal funds rate is what we're looking for because they oftentimes indicate a signal for change. Now, purple line, federal funds rate, interest rates. Green line is 10-year US Treasury. In late 2022, notice how the federal funds rate crossed above the 10-year US Treasury. The Federal Reserve was raising interest rates to cool down the economy. Interest rates currently stand at 5.5%, 10-year US Treasury 4.15. Now we can see here the crossover occurred October of 2022. Why didn't the 10-year US Treasury climb up even higher? Well, the higher interest rates started to take its toll and cool down the economy. Remember, the 10-year US Treasury yield moves with the economic growth. But if economic growth cannot fight those high interest rates, we see what happened exactly here. Now, the white histogram bars in the background show us the spread between the two. And the moment that the interest rates crossed above the 10-year bond, this spread went negative. That is the signal, one of the signals that we're looking out for. That again occurred October of 22. How often does this happen? Not very much, actually. Going back to the year 2000, we have, well, first off, the year 2000, 2001. We had a very strong stock market. The white line here is the S&P 500, and this spread was negative. Now, please keep in mind the negative spread is not a warning sign. It's not a sign that the economy is about to fall apart. Actually, quite the contrary. The negative spread simply shows us that interest rates are above the 10-year bonds. It shows us the stock market's very strong, the economy is very strong, the yields are very strong. So the Federal Reserve has been forced to raise rates. This is the result of the Federal Reserve being proactive to try to slow down a very hot economy. Notice now when the crossover occurs, when the spread goes back positive, when the Federal Reserve cuts rates, that typically sparks the beginning of the stock market sell-off. We go to 2007, very strong stock market, very strong economy. Fed raises rates, that spread goes negative. But notice again, the crossover. When the spread goes back positive, when the Fed cuts rates back below the 10-year bond, the stock market starts to sell off. Does the cutting of interest rates back below the 10-year bond force stocks down? Quite the contrary. The Fed's reaction in this case. The stock market is a great leading indicator. The stock market is moving in anticipation of a cooling economy. They're the ones watching manufacturing numbers and consumer confidence and all these other economic reports. Traders start to sell stocks in anticipation of a cooling economy. The Federal Reserve sees the stock market and sees the numbers, but they're not as fast as the sellers in the stock markets. Fast forward to present day, stock market's very high. We have a negative spread, actually a very deep negative spread. But again, the negative spread, when the interest rates are above the 10-year bond, it's not a warning sign that things are about to get bad. Quite the contrary. It shows us the Fed has raised rates because they're concerned about high interest rates, or I should say high inflation. They're concerned about an overheating economy. Now, inside this indicator, this is what it looks like. The green line is the Fed funds rate. And we can see here in the year 2000, the Fed raised rates above the 10-year Treasury. But notice the economy started to slow. The Fed bonds, rates back below the 10-year bond, and we see stocks. Well, first of all, we see the spread turn back positive at this point here. The spread turns positive as interest rates fall back below the 10-year bond. And that sparks also the beginning of the stock market sell-off, or coincides with it. The stock market sell-off actually starts while the spread is still negative, but when the negative spread starts to contract. Now, 2007, the Fed raises rates, very strong economy. Then the Fed sees the economy's cooling, they start to cut rates. Fed funds cross back below the 10-year bonds, and we can see the spread goes negative. The spread going negative is a sign that the Fed has now seen the economy is cooling and now it's time to start, cutting interest rates. But notice within the circle over here, the Fed actually started to cut rates in September. The spread was still negative, but it's not that the spread turning back positive is the best signal. It actually occurs before that. We want to see a contraction in the spread. And I think that's the biggest takeaway today. We're going to take a look at just a moment where we are now. We're looking for a contraction in the spread, where the Federal Reserve just starts to cut interest rates approaching the 10-year bonds. Notice what happened, by the way, in the year 2000. This is the S&P 500 in green. When the spread turns negative, the stock market really starts to take a spill to the downside. But stocks were already kind of weak when the spread was just contracting. It's not enough that the spread turns positive. We want to look for a negative spread that starts to show signs that it may turn positive. Well, fast forward to present day. We have federal funds rate well above the 10-year bond. The Fed certainly was very aggressive in raising rates, currently at 5.5%, 10-year bond 4.15. Now the question is, in the next day or so, we have a Federal Reserve meeting. Now, the anticipation is they're not going to cut rates in the next day or so. There's almost a 50% chance the Fed will cut rates in March. And if they do so, then the wide anticipation is a quarter point from 5.5 down to 5.25. Certainly not back below 4.15. But with that said, we want to see if the economy really starts to slow. Remember, the Federal Reserve is watching the economy. That's how they're making this decision, obviously, where to adjust interest rates to. So if we turn around in the March meeting or in the May meeting and we see consumer confidence in very bad shape, manufacturing is already in very bad shape, home builders, well, that's a difficult story. There's low inventories. But nevertheless, we want to look to see the state of the economic calendar. And if it looks like things are so bad, the Fed is going to have to start cutting rates faster, well, we should be aware of this contraction. Right now, the spread is between 4.15 to 5.5. So we want we want to keep our eyes out to see if the spread starts to contract. And of course, the stock market acting as a leading indicator may also give us signs of that. But at least now we have a game plan moving forward. One of the most important indicators, I think, in the next year or so is going to be exactly this: the spread between the federal funds rate and 10-year Treasury. And we look to history to see what has transpired in the past, and maybe that'll give us a clue moving forward. If you have not already, please visit our Substack newsletter, substack.com. No registration required. Please enter our details here, and you will see our brand new publication, The Real Cost of Inflation. We put aside the traditional CPI, Consumer Price Index, and look for a more meaningful source of inflation data. How much has a cup of coffee gone up over the past 40 years? Has it gone up more or less than the price of gold or the average home in the country? Well, we take a look at a number of different data points going back over 40 years to try to get a better read on the real cost of inflation. It's a very interesting read, and I think it's also very apropos. We hope this has been helpful. We look forward to seeing you back soon.